Welcome to The Explainer. Today we're diving into a highly strategic 33-page white paper from Elite Solutions Sweden titled Algorithmic Trading in FX and Options, What Your Platform Must Deliver. Look, this explainer is designed as a professional teaser specifically for you, CTOs, heads of trading, and product leaders at retail and mid-tier broker-dealers. If you've been wondering why platforms running on legacy infrastructure are quietly bleeding their best algorithmic flow, well, you're in exactly the right place. So here's our agenda for today. We'll cover 1. The core infrastructure gap, 2. 5 key evaluation criteria, 3. FX versus options liquidity, 4. MiFID II compliance imperative, and finally, 5. Conclusions and next steps. Let's get right into it. This 33-page document is our foundation today. It diagnoses a pretty critical market failure in how retail and mid-tier brokers actually support algorithmic flow. It was written by a practitioner with deep institutional execution experience at places like Saxo Bank. And what's really great is that it focuses on what professional and semi-pro algo traders actually require from a platform rather than what brokers just assume they need. Section 1. The core infrastructure gap. To ground this in some undeniable market reality, algorithmic trading now makes up an estimated 70 to 75% of all spot FX volume on major venues. That's a massive tectonic shift in the market. But despite this huge volume, a staggering number of brokers are still operating on tech architectures built for a totally different era of discretionary human trading. Now, what's really fascinating here is the stark myth versus reality contrast between the superficial metrics that brokers like to market and the strict technical realities that professional traders actually measure. Ask a broker how they evaluate their platform, and they'll proudly point to tight spreads and a broad instrument range. But algorithmic traders, they're looking under the hood at execution latency, API reliability, and order book depth. This gap right here is exactly where client attrition begins. And the scary part? These traders rarely submit formal complaints. They just quietly reduce their volume or leave altogether. Section 2. 5 key evaluation criteria. The first criterion we need to look at is execution latency. And latency isn't just basic network speed. It includes the processing and confirmation lags that rear their ugly heads during critical, high volatility events. A platform might run perfectly fine on a sleepy Tuesday morning, but if it totally degrades during a major U.S. non-farm payroll release, an algorithm running a momentum strategy is going to suffer disastrous partial fills. To put it simply, network latency above 80 milliseconds basically disqualifies a platform for high-frequency strategies right out of the gate. The second is order book depth and transparency. Look, without visibility into market depth, any algorithmic strategy that relies on size estimation is structurally compromised from day one. Offering a single price quote just introduces a fundamental information asymmetry. Because of this, professional traders are increasingly and rightfully demanding genuine Level 2 order book access, or at least transparent disclosure of exactly how the broker is aggregating its liquidity. Criterion number 3 is API reliability. The API is the absolute bedrock of the entire trading operation. Now, a perfectly designed API that suddenly degrades or disconnects under heavy load, that is viewed as far worse than a consistently stable connection that might be just a tiny bit slower. If your API throttles undisclosed connection limits during peak times, it creates these invisible execution gaps that completely compound a trader's risk. Fourth on our list, we're looking at slippage consistency. Now, your average slippage might look perfectly acceptable on a glossy marketing summary, but hidden extreme outliers will absolutely destroy the expected value of a momentum or news trading strategy. Professional algo traders aren't just looking at averages. They measure slippage systematically. They break it down by time of day, by instrument, and by specific market conditions. And finally, the fifth criterion, the backtesting environment. This demands high-fidelity historical replication, meaning you need tick-level granularity, highly realistic latency simulation, and accurate fill logic. If your backtesting environment uses uniform spreads or just assumes instant fills, it's going to spit out disastrously optimistic strategy performance estimates. The transition from testing to risking live capital has to be based on hard evidence, not guesswork. Comparing these benchmarks brilliantly highlights that massive technical gap between a setup that's merely adequate and one that truly crosses the professional grade threshold across all 5 of those metrics. For instance, look at how standard API connections might give you under 80 milliseconds of latency, but a true professional-grade platform requires a co-location option that drives that number down under 10 milliseconds. Or consider backtesting. Adequate setups offer basic tick data, whereas professional grade requires a full historical volatility surface for option strategies. It's a completely different ballgame. Section 3. FX versus options liquidity. The crucial takeaway here is understanding the structural difference between the spot market's continuous double auction and the options market's complete 100% reliance on the volatility surface. FX spot algorithms rely on continuous, rapid pricing updates for a homogeneous instrument, but an options value? That depends on implied volatility, inferred across various strikes and expiries. Options algorithms literally require multi-leg execution and continuous, real-time computation of Greeks for dynamic hedging. Conflating the two, like applying spot pricing models to options, exposes the platform as structurally inadequate for true options algorithms. As this incredibly powerful quote from the white paper puts it, omitting real-time vol surface data means the algorithm is essentially pricing blind. If you're forcing an option strategy to run without a volatility surface, you are basically guaranteeing that algorithmic flow will not stay on your platform for very long.
Section 4. The MiFID II Compliance Imperative.
Now we shift to regulatory realities. These are not just optional, nice-to-have enhancements. Failing to implement granular pre-trade controls and a tested kill switch exposes brokers to severe regulatory sanctions under MiFID II. Broker-dealers providing market access absolutely must enforce price collars calibrated to specific instruments, per-client order size limits, and robust message rate controls. And crucially, you have to maintain an immediate, independent kill switch that can cancel all outstanding orders from a specific algorithm completely independent of the client's own systems. When mapping out these requirements, it becomes clear that most technically capable brokers actually have the systems in place, but they critically fail on governance documentation. Think about it. When regulators conduct inspections, the price collars and message limits are usually working fine. But on the documentation side, stress testing records under peak loads are often completely missing. An incident log tracking exactly when controls are triggered is frequently absent. Closing these documentation gaps is hands down the most cost-effective way to immediately reduce severe regulatory risk. Section 5. Conclusions and next steps. It is time for tech and trading executives to critically evaluate if they're risking their highest value clients on legacy architecture. Actually, with AI-assisted strategy development rapidly lowering the barrier to algorithmic trading, the addressable market is expanding fast. The platforms that provide transparent slippage stats, genuine tick-level historical data, and dedicated volatility surface infrastructure, those are the ones that are going to capture a disproportionate share of this high-value base. To dive into the complete roadmap and really bridge this gap, ensure you request and review the full 33-page white paper today. It includes a highly valuable ecosystem comparison outlining exactly where platforms succeed and fail from the professional trader's perspective. Thank you so much for joining me for this explainer. As you review your own systems today, I want to leave you with this thought. If your highest volume algorithmic client left tomorrow, would your legacy infrastructure be the hidden reason why?